Why investors ignore every warning before a crash. We've had hundreds, if not thousands, of crashes in the past, and all of them follow the exact same pattern. So why do investors keep falling for them? Who wants a financial crash? Everybody wants the economy to grow. The more the economy grows, the more the markets grows, the more everybody else makes money. But what if I told you that the system is designed purposefully to crash every few years? Financial crashes are a fact of life, and even if investors pay attention at those warnings before a crash, they can't stop a crash, and it's going to happen. I know that this sounds like a conspiracy, and it's very difficult to comprehend that, but by the end of this video, you will change your mind, because I'm going to give you the facts and will tell you exactly why stock market crashes are inevitable. So if you're ready, give this video a thumbs up, and let's get right into it. The biggest crash in American history is the 1929 crash when the S&P 500 fell by 90%. 90% crashes are very rare because it wipes out 90% of the wealth out of the market. But very few people know that the market crashed again in the middle of the Great Depression by about 50%. Then we had the crash of 1973, the famous dot-com bubble that crushed the Nasdaq by 80%, the 2008, the 2017 Bitcoin crash, and so on and so forth. The last one was the 2025 Bitcoin crash. And these are just a few crashes. If I'm going to talk about every single crash that has happened, this video is certainly going to be 50 hours long. But it's normal that people want to profit out of the market because the nature of the market that it continues to grow. The more businesses we build, the more technologies emerge, the more the new industries come up, the faster the economy grows. And if you want to profit out of it, then you start investing. And it's very normal that we have a new technology, an internet, smartphones, AI. You invest your money, the economy grows, and you make money out of it. And when the market is growing, nobody's actually going back into historical data to figure out whether it's a bubble or not. Because our brain, our bias, there is something called a recency bias. We always focus on the most recent information and not on the historical data. So if over the last 12 months the market has been growing, that's when the attention of your brain is onto. And that's what we call a recency bias. And then you go into the internet and you start looking for information that is going to confirm that. So if you're an investor in Palantir, you're going to look for information that is going to confirm your opinion that Palantir will continue rising. If you are a Bitcoin investor, you will start reading articles, watching the people that will tell you that it is going to continue rising to trillions of dollars. And it's very difficult to watch how everything is growing while you're not involved, because there is something called the fear of missing out. When you see your friends making money, when you see people on the internet making money, you want to jump in and profit as well. There is even a famous story of Isaac Newton, who was one of the smartest people in history, who fell for it as well. He was an investor in a British company back in the days. When the stock rose, he sold his stocks and cashed out. And then he watched how that stock keeps growing faster and faster and faster. And he was very disappointed that he got out very early. He thought that he could make a lot more money, especially when he saw the people around him are massively profiting from his stocks. So he dumps most of his wealth into that stock again. It turns into a bubble and then it crashes, and Isaac Newton loses the vast majority of his wealth with that transaction. So if the smartest person in the world has fell for it, what do you think is happening to the rest of the people? But what if I told you that this is not why stock market crashes happen? The real reason that markets are falling down are because of derivatives. The total value of derivatives are about $1 quadrillion, and it's a time bomb at the heart of the market. Not $1 trillion, not $1 billion, not $100 trillion, but $1 quadrillion. You can literally just Google how many zeros a quadrillion has. The size of the US economy is $30 trillion. The size of the derivatives market is $1 quadrillion. The size of the global economy is about $136 trillion. Versus $1 quadrillion of derivatives market. Derivatives are literally the place where you can bet your money. If you think that people have gambling addiction with cryptos or when they go to Vegas and throw millions of dollars overnight, then you don't know what a gambling addiction is. The largest gambling market is the derivatives market, where people or investors or huge financial institutions are betting trillions of dollars every single day. There are a lot of instruments in the derivatives markets, but we will take a look at the three most important ones. First of all, options. Option is a contract that gives me the right to buy or sell a certain stock at a specific price sometime in the future. So imagine I am investor A and I believe that the stock A, which worth today $100, is going to fall, and I'm going to buy put option contracts from investor B. Now, investor B doesn't have the motivation to get into this contract with me, so I'm going to pay him a premium or an interest throughout this put option contract. If the price of this asset rises to $120, now I'm not going to exercise my option because I can simply buy it for $120 and sell it to him for $100, and I'm losing money. But what if I'm right? What if the price of this stock goes to $80? Now I can exercise my put option contract, and this investor has to buy it from me for $100 per stock. I'm going to buy it for $80 and sell it to him for $100, and I made a $20 profit. Now this doesn't seem like a big deal, but then what if this put option contract were worth millions of dollars? What if they're worth billions of dollars? So even if there is going to be a small correction in the market, the second investor doesn't have enough cash to fulfill this put option contract. When you get into such a contract, you don't need as much cash to do that. So if the market falls, now the second investor is doomed. Now he has to sell most of his portfolio to ensure that he can back up this put option contract. Now, a single investment doesn't seem like a big deal, but when the market falls slightly and hundreds of billions of dollars, if not trillions of dollars of put option contracts must be fulfilled, there is going to be a massive sell-off by all these investors in the market, which is going to amplify that crash. So a crash that could have been just 5% instantly turns into a 20% crash. The second type of derivatives are futures. They're literally called leverage bonds. A future contract is a contract to buy or sell a certain asset at a specific price at some time in the future. So unlike the option contracts where I have the right to either exercise or not this contract, a future contract is a contract that must be exercised. Why would investors do that? Let's imagine that there is stock X. Let's imagine that this is Palantir and its price is $200. And standard future contract has about 100 shares. So if I'm going to buy 50 futures, that means that 50 multiplied by 100, that's how many shares I'm going to buy. So, since the price of the share right now is about $200, the total value of this future is about $1 million. But to get this future contract, I only can put a margin of about 10%. With $100,000, I control a portfolio worth $1 million. If the price of Palantir did actually rise by 10%, the value of this contract has increased to $1.1 million. So I essentially doubled my $100,000 to $200,000, even though that the price of Palantir just increased by 10%. It's great, fantastic, everything is growing. But now the real question is, what if the price of Palantir falls down? Let's imagine for a moment that it falls to $150. What's now? What happens to the value of my future contract? So 50 contracts multiplied by 100 multiplied by the new price of Palantir, which is $150. So the value of the futures contract has fallen down to $750. Theoretically, I have lost $250,000. Of course, if this contract is not exercised yet, then I'm not actually losing anything. But that's not how this system works. Since I got into this contract with as little as $100,000, I've actually lost far more than $100,000. And now I'm left with two options. Either I'm going to deposit more cash into my account to back up these futures contracts, or I'm going to get a margin call from my broker, which means that my broker is going to sell at least $1 million worth of my portfolio to ensure that there is enough cash to back up this future contract, which is why I might be selling my Bitcoins, my other Palantir stocks, or whatever I have to ensure that my account actually has at least $250,000. So the more the price is going to fall, the more I'm theoretically losing, the more I have to sell. If it's a single future contract, it is not going to have a massive impact. But what if the price of Palantir does actually drops by 10 or 15% and there are billions, if not hundreds of billions of dollars worth of Palantir futures and all of them must be exercised? All of these Palantir investors suddenly either to have to sell their Palantir stocks or any other stocks they have in their portfolio to back up these futures in order not to go bankrupt. Suddenly, there is a massive sell-off in the market, whether they want it or not, which is going to further crush the price of that particular asset or maybe the entire market. And that's how a 5% crash easily turns into a 20% crash. The third type of derivatives are swaps, and these are literally betting. Imagine you have two investors, investor A and investor B. Investor A wants to bet that the price of this asset, it could be anything. It could be a stock like Palantir, or it could be Bitcoin. And investor A believes that the Bitcoin price right now is 100K and it's going to rise by 10%. So investor A will tell investor B, listen, let's bet on this thing. If the price is going to increase by 10%, you are going to pay me the difference. So if the price today is $100,000, it grows to $110,000, you are going to pay me that difference. I don't have Bitcoins, you don't have Bitcoins, but with swaps, we can actually do this transaction. It's literally betting. But if it falls by 10% or by whatever percentage it falls, then I'm going to pay you because it had fell down. The second investor would look at this and is like, I don't want to get into this transaction. I'm not really in a mood to bet. So the first investor will tell the second investor, I'm going to pay you interest throughout this bet. So if our bet is 2 months long, then throughout this 2 months, I'm going to pay you a specific amount of interest. So the second investor is like, all right, fine, let's get into this bet because I believe that the price of Bitcoin either going to stay the same or maybe it is going to fall. I don't believe it's going to rise. So worst case scenario, I will make a lot of money. If the price does increases, yes, investor A made money and now investor B has to pay investor A the 10% difference. But what if the price of Bitcoin does actually falls by 10%? Now investor A has to pay investor B $10,000. What if it falls down by 20%? Now investor A has to pay investor B $20,000. Getting $10,000 or $20,000 is easy. But what if this swap was worth millions of dollars, maybe billions of dollars? Suddenly investor A owes investor B billions of dollars, or at least hundreds of millions of dollars, and he doesn't have that much cash. Now he's forced to sell his other assets, or maybe he has some Bitcoins. He's forced to sell his Bitcoins to ensure that he can pay investor B. Yes, there was a reason that the price of Bitcoin has fallen down by 10%, but now the reason it has fallen by 30% is because there has been so many swaps contracts in the market and so many investors now have to sell their other cryptos or other stocks to ensure that they can fulfill these swaps contracts. So even if the market falls by a few percentage points, the derivatives market always amplifies that crash. So a 3% crash sometimes can turn into a 10% crash. A 10% crash can turn into a 50% crash. This is the main reason why even though that the crash is going to be small and investors look at that, they don't see a sign of a major crash, the derivatives market is going to amplify that crash. And there are always going to be reasons why there is going to be a small crash. For example, during the pandemic, there was a small crash. Some investors panicked, they started selling off, and suddenly put option contracts, futures and swaps and other derivatives instruments, all of them had to sell a lot of assets to fulfill these contracts, which is why a small crash has turned into a huge crash. Sometimes early investors began to sell a certain asset. So imagine you are an early Bitcoin investor. You purchased it at $1. And now the price of Bitcoin worth like $100,000 per coin. And you want to sell a few of your coins and you want to just, buy yourself a Ferrari or a Bugatti. You sell a few of your Bitcoins, suddenly the market slightly moves, and that is going to cause a lot of these investors to exercise their put options, futures, or swaps, and that 3% crash turns into a 10% crash. Or maybe because the Fed has increased interest rate and that actually taken down a few very weak companies, that has actually led to a small drop in prices, which has led to a huge crash. Or sometimes it could be one country goes bankrupt, such as Greece, back after the 2008 financial crisis. So the system is designed that even small little crashes, which are going to happen whether you like it or not, are easily going to be amplified by the derivatives market. And if you're new to investing and you want to start and you don't know where, there is going to be a fully animated video somewhere here on the screen that will teach you everything you need to know to get started.